With massive layoffs in nearly every sector, weakness in manufacturing, car sales, and housing, and the biggest one-month decline in the trade deficit since the financial crisis, the economic picture is not looking good, which might explain why so many billionaires are loading up on gold, including hedge fund manager John Paulson and real estate mogul Sam Zell. Bottom line, now is the time to own gold, which is why the experts at Stansberry Research just stepped forward with a major gold prediction, arguing gold could soar as high as $3,000 by the end of the year, possibly even higher. You can find out why and get instant access to their #1 gold investment today. It's not bullion, an ETF, or a mining stock, but in the past, this gold strategy could have made you nearly 50x your money. Considering how quickly the price of gold has been moving in recent weeks, you don't want to waste any time missing out on the gains these experts believe are in store for this gold stock. To get a copy of his new free report with all the details, simply go to goldmaniareport.com. Again, that's goldmaniareport.com for a free copy of his new report. Hi, this is Daniela Cambone, and welcome back to the Daniela Cambone Show here in person with Hugh Hendry, founder of Eclectica Macro. He's also a former global macro hedge fund manager, and he has a lot to say. Welcome back to the show, Hugh.
What a delight to be in New York City.
Welcome to New York City. How have you been?
Yeah, I mean, I'm always on the road. I've been on the road for 3 months, so this is just another pit stop.
Holy moly. Yeah, but you love it.
Yeah, I do love it. Yeah, I meet some amazing people like yourself, and all these opportunities to kind of try and understand what the hell's going on in the world.
Yeah, well, I love following you on social and following you all over the world, but we have a lot of important conversation pieces to talk today. I thought we'd start with your views on the banking crisis. We are 90 days and a bit into this. 4 banks, bye-bye. Where do we go from here? How bad or better can it get?
Well, it gets a heck of a lot worse before it gets better.
Worse than 4 banks out?
Yeah. So there is a thread, if you will, that I can trace back to a very similar economic regime to that which we're under today, which is the 1920s, where we kind of swapped the role. The US was this new industrializing force that come to the fore and was like, trading with the rest of the world and winning. Yeah. And the deal back then was that you would pay for those exports or imports with the transfer of gold. Mm-hmm. And the idea is that gold, we're under a gold standard. And so gold represented high-powered money. It would be deposited within the banking vaults of the private sector, the banking sector, and that would be a liability. And the banks would be like, we got to pay deposits, money, And so you would seek, liabilities need an asset, and you make loans, and that would be kind of like a coup of whiskey that would make a strong economy even stronger. But in doing so, a very vibrant domestic U.S. economy would be one that would import goods and services from Europe.
Right.
That didn't happen. And the same thing today is going on with China playing the role of the US, and its currency should be appreciating and making the Chinese citizens richer vis-a-vis America and making stuff made in America cheaper. And they're like, yeah, I'm going to take that down. And that's not happening. So if we cast our mind back, like over the last 30 years, China has grown from a GDP of like under $1 trillion. Today it's 17 trillion. Today China is the same scale and size as the European economy. It's enormous, right? And yet, from point to point, currency has devalued. Mm-hmm. Chinese have got poorer. And so America's kind of, and the rest of the world are kind of left at a disadvantage because the folks in China don't have the wherewithal to buy the products from the rest of the world. And so the system doesn't balance, and one of the repercussions of that is that there's a huge tsunami of liquidity from overseas which comes in and it inflates US asset prices, right. And it makes the US system very, very fragile. So again, if we cast our mind back to the 20s, what you saw was the deficit. Countries like Europe, they started to really have problems. They had bank runs, yeah, and then the thing blew up, and then the US banking sector in 1930 infamously went bankrupt. It went to zero. We were on a Bobby digital system. It was like 0 or 1, and we went to zero. Now, at that point, the Fed stepped in because what was happening was people were pulling deposits out and like, well, I'm going to hold gold coins. And the Federal Reserve Act of 1934 said, no, you're not. We're going to confiscate that behavior, and any coins you have to turn them into the Feds. Like strange things happen when the world really comes to the brink. So the modern analogy with that is, can the US banking system sustain this deposit flight? Big question.
Right, and I remember bringing it back to our interview last time, the biggest takeaway is that you were basically telling us in November or October to panic. And you're still saying we should be panicking. But what most concerns me are your thoughts of how maybe our funds might be locked in the banks. Is this a true concern that you think could develop?
Well, so if we went back a year ago, the probability you would assign to that would be almost zero.
Yeah.
Okay. And all I'm saying is that probability, like Mercury, is rising. Okay. Why is it rising? It's rising because we have experienced, I call it the Fed folly. But one can say factually that this Fed hiking is the fastest and of the greatest magnitude, that they've never done this before. Okay, that's just to state the blinking obvious, okay? Why haven't they done it before? They haven't done it before because it's inherently destabilizing to the US banking system. Why is it destabilizing? It's destabilizing because the banks can't match the Fed funds rate instantaneously.
But people are going to say, but Volcker did it.
Okay, so Volcker, right, was 40 years ago. Yeah. And back then, debt, in the 1970s, we had completed the deleveraging from the bankruptcy of the US banking system in 1930. It takes 40 years for society to kind of, you have financial repression and you work down the debt load vis-a-vis GDP. So in 1930, debt was 3.5 times GDP. That's where we are today, right? And it came all the way down to about 1x GDP. So 1x GDP, you could raise rates, okay? Today, so I would say to you, the Fed at 5% or 5.25%. If you multiply that by 4x debt to GDP, we're at Volcker levels, okay? And Volcker broke something. He broke the economy. We had the sharpest contraction in US GDP since the Second World War. He broke things, okay? And we're breaking things. We're effectively at 20% interest rates, and we've broken the bank, or they've broken the banks.
They could reverse this by stop tightening. Why won't they? Or will they?
So you're right. Again, let's just examine the stress, okay? So the Fed goes really rapidly high. The bank are offering you like 10 basis points on your CD, okay? Because they're banks and they're mean, maybe a little bit, but because their loan book, their asset book, it reprices slowly. It takes 18 months for that thing. But the Fed goes to terminal within 12 months. So the banks kind of start protecting its net interest margin. The Fed's up here, and so it elicits deposit flight. And then what none of us knew was we now have weapons of mass destruction in our pocket. Like, it's so easy to pull money out of the bank. Hello, bank. Boom, we're leaving. So a combination of being stuck with these very uncompetitive rates, and now the tyranny that money can just fly so quickly, right? Has caused the departure from this commercial life of 4 banks. Is the Fed getting the message? It would seem no, because they just raised rates again. So the thing that's pulling money out is the Fed's offering too much via money markets. I mean, you can go to the Fed directly, right? And so what's the Fed doing? It's encouraging more and more and more money to leave. So now people are like, hey, Hugh, be quiet, because the banks are now offering very competitive CDs. Right. But as they offer like 5% CDs, right, their net interest margin now is heading to zero.
Do you think it's interesting that the blow up has happened at the regional bank level? Do you think there's anything behind that? And two, to your point, right? Who would be wanting to put their money in a regional bank or invest in a regional bank at this point?
Well, I mean, regional banks are great, and they provide a wonderful service to the local.
Right. You think it's important for the ecosystem of the bank?
There's nothing wrong with it. But so what? Well, this is folks. This is the stuff they don't tell you, right?
Yeah,
okay.
Yeah. This is what I want.
So the situation, the scenario I've been describing, okay, had put profound funding pressure on the smaller banks, okay? Funding pressure, their profits are getting constrained, okay? And they're needing funding. Now, in the ordinary course of daily events, a bank goes into the repo market and it says, hey, look, I want to offer you the collateral of $1 billion of my loan book. This is diversified across maybe not across the country because they're regional, but across the region, but it's diversified across industry, household and corporate, size, we got mortgages, we got business loans, okay? And typically the money center banks who are flush with liquidity, right? They'll come in and they'll say, yeah, okay, we will lend you our US Treasury bills, and with that you can then finance the daily banking operations. Now, what happened in January, February was, Jamie and gang are like,
right.
Yeah, we're not accepting, or the haircut that we're going to demand to accept your collateral of all these loans, we don't want it. And so effectively it was the big banks that closed the regionals because it closed their daily access to funding, and then that caused the blow up.
So what is there a concentrated effort there to move towards the direction of only having 3 banks in the USA, or would you say this is just conspiracy talk?
I think it's conspiracy. The best way of understanding life, I think, is that it's a cock-up. Life is full of cock-ups. Mostly it's well-intentioned, but it leads to hey, listen, here we are in New York City, okay? Here we are, the bastion of asset capitalism, and we have a group of bureaucrats that meet every 6 weeks, and they go, where should we set interest rates? Well, let's have this kind of philosophical conversation. Let's call in some PhDs. And it's like, let's just not do any of that, because the genius of the market out there in the streets, right? We have the yield curve, right? We have people, and some of them want to make a quick buck, but mostly enterprises have to look to the future, and they've got to hedge themselves, and they've got to take a view. And the genius of the market price is it captures all of that broad church. And that's the real rate.
Are you talking ending the Fed?
We need a Fed. We need a lender of last resort. But we don't need a bureaucratic setting of interest rates. Because there is a natural rate of interest, and the natural rate gets revealed when the Fed fights the natural rate. We have an inversion in the yield curve because Fed funds are way beyond the level and the capacity of the economy to endure.
But I want to get back to the point about your cash might be frozen in the bank or we can't access it, because this is a huge point and what most of my audience fears. And if that's the case, what are we supposed to do? Are we supposed to pull all our money out of the banks and be in other assets? What should we do?
You should just be cognizant of tail-like risk. We no longer live in an environment where it seems prudent to have all of your money, first of all, in the banking system.
Correct.
And certainly not congregated around one lender. You need diversity, you need options, you need a choice. Again, this weapon of mass destruction, I want to say to you that we pushed Humpty Dumpty over the wall. Humpty Dumpty's broken. We ain't putting him back again. With all of the Fed's men...
And women.
We ain't putting Humpty Dumpty together again.
Talking about weapons of mass destruction, central bank digital currencies, another big concern for many coming down the pipeline. I want to know your thoughts. Does it keep you up at night?
Nothing keeps me up at night. Well, some things keep me up at night. We live in our modernity, we think we're super smart, and we're so super smart versus the previous generations.
Of course.
And it's a conceit. We're as dumb as them because we're human beings. Right? We seem to require idolatry And this is where the Fed comes in, because, I mean, their psychops are incredible. I mean, they have convinced everyone. The one thing you got to believe is you got to believe in the Fed. You know, the aura, the invincibility, the power of the Federal Reserve. If you have an asset, you need a liability. If you got a God, you need a devil. You need a bogeyman.
Oh, right. Yeah? Like the Joker to Batman.
There you go. And the Joker is this thing that sounds like a drug, the CBDC. I'm like, hey, can you send me over some CBDC? I'm lonely tonight, you know. I would say to you, okay, I compare CBDC to TikTok. Can some of the good folk out there, actually tell me what is the danger of having TikTok in your phone? Like, are the communists watching you kind of like singing songs?
Access to your data, but here's the difference.
But it's not. We can categorically tell you that
They're
is
spying.
not a fear.
So you think it's ridiculous that Justin Trudeau up in Canada banned his members of parliament?
Well, first and foremost, I think Justin Trudeau is ridiculous. There are bigger things to be concerned about at this present moment than CBDC.
De-dollarization.
Is profoundly silly. De-dollarization is, I don't play poker because, you know, my face reveals everything. You know, I can't keep a secret. I'm like, you know. But you're China and you're at the poker table and you're looking at your hand, you're going, melt. Yeah, I got $40 trillion of deposits. I'm trapped. You know, I've got a property market at $60 trillion. We really screwed up. Okay. And what do? You go, yeah, I raise you. Yeah, the bluff at the poker table. De-dollarization is a bluff. Okay, so it's coming to the fore because the Western financial media are very compliant. You know, the joy of our system is we entertain all brick brats. You can criticize us. We're good. We're robust. We can take it on. And our media love to kind of glorify. Because we're winning, the media wants to take us down. Fine, okay. But the intensity of the de-dollarization debate, and it's a debate sponsored by autocratic regimes overseas, and they're running out of dollars. So first and foremost, I have absolutely no issue. You want to use red cabbage. Forgive me, I call it red cabbage, but renminbi, okay, in terms of settlement. So I'm a Brazilian iron ore producer, and I'm going to send you over some iron ore. Yeah. And feel free, you know, Lula, the Lulu president of Brazil, he said, yeah, we're going to accept red cabbage. I got no issue with that. No one has an issue with that. Go forth and multiply, okay? However, when the commercial enterprise receives red cabbage, what are they going to do with it? Because remember, there's a closed capital account in China. You can't go and put it in a Chinese bank account. You can't go and buy Chinese treasury bills. You don't really want to go and buy Chinese property. They won't let you anyway. So what are you going to do about it? You're going to transfer it into dollars and you're going to hold it in T-bills. So, and the other thing is, yeah, Saudi Arabia and China are going to trade with red cabbage. Again, great guys. Have fun, okay? But let me tell you, the daily turnover in the crude oil financial futures is like 1,000 times the cash transactions. It's irrelevant.
Okay, let me throw this out. Maybe it's not an existing currency. Could it be a replacement currency? Perhaps a BRICs reserve currency backed by whatever?
What are you doing to me? Okay, first of all, okay, let's talk about...
Okay. Are you saying you don't see the end ever of the US dollar as a reserve currency?
I pray on my knees every day for the end of the US reserve currency, okay? And that day will come when the great workers and people of the United States of America find leadership that will reject the status quo. This system will end when the host, the United States, rejects it.
Why do you want it rejected?
Because it's impoverishing everyone except Wall Street. We have this weird combination where you've got the Chinese Communist Party and and Wall Street, and they're the only ones that benefit. Okay, so how do they benefit? We operate up until 1998. We, the world, financed emerging growth opportunities, right? They would run trade deficits and we would fund them with capital flow. South Korea went from impoverishment and is now as rich as we are on that model. But in 1997, 1998, Thailand et al., they all devalued and defaulted, and all of their political leadership was cast aside. And China looked at it and thought, we ain't doing that. So, like, America was an emerging market in the 19th century, and it was funded by the UK. That model doesn't work anymore. And so China has to be self-sufficient in funding all of its stuff, okay? And so it creates a distortion on its population, which is very high rates of savings. Why are they high? Because the Chinese Communist Party does not provide you with universal health care.
People are going to say that's a very American-centric way of looking at things. Ironically, not from an American, but to think that it's up to the U.S. if they want to abandon their reserve currency status, and only them, and they can protect it at all costs. But what happens? I know you balked at the BRICs, but they are rising in power.
Are they?
Absolutely. Look at their GDP. And why can't you fathom a reality where they would have a reserve currency that would overtake the U.S. dollar? I'm asking this
okay.
Sincerely.
So let me answer this try and answer this without my verbiage. Okay, let's look at...
I feel like I'm in marriage counseling. This is... Okay.
God,
I feel like I'm talking to Max Kaiser.
God forbid. But yeah, I got problems. But anyway, we'll discuss later. So Russia and India, the in the BRICs, okay? Okay. Are you aware of what's been happening with the in the BRICs?
I know what's happening with the
Well, the Russians, right?
Right.
They have accumulated. So they're like, we ain't trading US dollars. And the Indians like, cool. And we're going to buy your filthy oil.
Right.
Okay. And we're going to pay you with our... if we had red cabbage, then the Indians would be curry dollars. I don't know, here you go. And we've reached a point now where I think the Russian central bank has about, not even a lot, maybe 50 billion. And they're like, we do not want any more Indian rupee. We want dollars. That is, go on your computer and look up that story. That is current. That the Russians are no longer accepting Indian rupees. Okay, so that's within the BRICs. They're already rejecting it. And again, let's review. China's the largest. It's 15% of global GDP, 17% of global GDP. India's 2%. Russia was 2%, but it's sliding lower, right? Brazil, less than 1%. What am I missing? BRICs, they're not that big. BRICs are China.
South Africa.
South Africa's irrelevant. Sadly, again, political leadership. BRICs are China.
Basically. Okay, I agree with that.
Now, again, you can only have a reserve currency. A reserve currency is not for settlement. They are free to settle without US dollars. But again, within Russia and India, the Russians are pulling back and they're saying, we will not accept any more rupees, okay? But they're free to do that. But for a reserve currency, you have to have an open capital account because you've got to take the cash from the settlement and own things. Like put it on deposit somewhere, and you can't do that. So BRICs can have an attempt at a reserve currency if China is willing to open its current account. And that's the thing they'll never do. The Communist Party will never do it because it would be relinquishing power, potentially relinquishing power.
Yeah, but for a greater good.
They're not in it. The only good is the perpetuity of the control of the Chinese Communist Party. Period. And so again, what happens is surplus savings buy US assets and Wall Street gets really rich. But the real folk end up... I was at a farm party in Pennsylvania and I met an incredible gifted artisan who made amazing wood benches and stuff. Do you know where he works today? He works in a sorting office for Amazon.
So sad.
And the people can't afford assets.
So sad.
Right? And it's the asset price inflation. Let me tell you, asset price inflation is not quantitative easing. Asset price inflation is mercantilist trading strategies that dump. It's essentially taking Mount Everest and dumping it into a lake, and the liquidity, which is then spread many times into the financial sector, is impoverishing the people of the United States and elsewhere. It was not conceived, it was not designed to operate like that. There's a fix, and the fix is for the United States, Trump was an outlet for that anger, but he's the manifestation of everything that is wrong with the financial system. But he was close to the anger. We actually need expert policy advisors that understand the world. The remarkable thing is there's only 5 people in the world that truly understand money. And they're not close to the centers of power.
You want to share the list?
No. But call me,
All right, moving on, because you said fixes. So
Fixes.
we threw a lot of stuff out there to the people. I always want to bring it back to what can we do on our daily lives? Like if you're talking about, assets being frozen, what should we be looking at? You said diversification. How do you like to, what are you doing? Hugh Hendry.
Oh, forget me, I'm a joke. The sad thing about this is if some bright kids come to me and they're like, hey, what should I do? With profound resignation, I have to tell them that they have to stay close to the locus of financial power, which is financial markets and speculation. Again, we've transformed in a very negative manner the kind of industrial and entrepreneurial genius of the American framework to one which is now inherently speculative. Every dinner party is all about people. I bought this house, we're renting it out, I've got a second home, and the price is this. That's where we are today. And so what should we? There's again we've discussed the fix. The US would stand up and you say, actually, we believe in flattery. You conceived of a system that's worked really well, and we want to copy that. So we're going to close our capital account, and you're no longer free to transfer all of this liquidity into our economy. Now, they don't do that because we would have a profoundly severe recession. But here's the irony. We're going to have a profoundly severe recession. The world's greatest living macro legend.
We keep waiting for the recession to happen. I feel like when we speak of it, it's like the gray monster will descend upon us. It's not going to change from today to tomorrow, right? That's not something that happens overnight. So
You've got kids.
Yeah, I have twins.
Yeah, and you take car journeys sometimes.
What? Car journeys?
Car journeys,
I love road trips.
Road trips.
AKA road trips.
Road trips.
Yes.
Let's go Jack
I
Kerouac.
like car journeys.
Yeah,
so
on the road.
I love road trips. I'm a road trip queen.
Okay. But what does the queen not like? Right. You don't like
the screaming children in the back.
The screaming children.
That's right.
Hey, mommy, are we there yet? Are we there? I'm like,
yeah.
Okay, so the hard thing about executing macro strategies is not to know the outcome. We know where we're going to, okay? It's the journey there. Okay. So we just got to chill, but it's coming. Again, you can listen out. Don't listen to me. Listen to Stan Druckenmiller. And Stan said to you in his Irison conference speech, he said, in his head, the probability of a very severe recession coming through towards the end of the year is really high.
Okay.
Mercury's rising. So protecting people.
Are you buying gold?
I wouldn't discourage buying gold. So people should. So let's make educational sounds pompous, but in terms of strategies for the real folk, okay? And let's think like the pros. The pros conceives of the world in 4 quadrants, compass points, okay? And the first one would be equities, and let's call that the S&P, okay? And then you've got fixed income treasuries, okay? And then you've got alternatives, and that's your gold question, that's your Bitcoin.
Yes.
There's a lot of alternatives that could be index-linked treasury securities, it could be real estate. And then the final one is like cash, and we've discussed the CDs, money market funds. Right. You might take a view on which currency to hold your cash, okay? So where I am just now is, there's nothing in the stock market, that I'm not in a hurry to own the stock market just now. I fear, like with recession, it can come lower. If you look just in that quadrant of the stock market, they're very interesting reveals. So that we have the S&P 500, and that only 10 stocks account for, in fact, they account for 120% of the rise year to date. And those stocks are deemed to be riskless securities. NVIDIA, Could we get a severe recession? Most likely. But there's an arms race in terms of AI and countries and semiconductors. These guys are just going to grow anyway, and people don't care about the valuation just now. So what you find is S&P long versus short the Russell, as an example, is just telling you that the stock market is actually concerned. Okay, you could do that again, S&P versus emerging markets. Okay, American S&P stocks, riskless securities, have destroyed emerging market stocks for the last 15 years, and they will continue to do so because of the monetary and trade regime that we operate under. So my equity bucket, kind of low. If I had to own things, I would have a small allocation to gold miners, uranium stocks, you know.
Wait, in the gold miners, you like the riskier bets, like the juniors, or are you sticking to Newmont, Barrick, ET? What are you doing?
But like, it doesn't matter. Like,
well, no, it does matter. I want to know the strategy. You're taking a safe bet.
So the old Soros maxim: you buy the worst in case you're right, and you buy the best in case you're wrong.
Right.
Okay, so the 3 and 3: a Newmont, a Barrick, and a couple of kind of jazzy ones. Okay. So that would my equity allocation would be kind of today 20%, no more, and it would be of that agricultural equities, uranium equities, gold mining equities, but no more than 20% of my allocation. My big allocation just now is the place where, ridicule me, laugh at
treasuries.
Me. Treasuries, the longest.
32 trillion in debt, and you're buying treasuries?
Yeah, because all you're revealing is prejudice, okay? And the price reveals prejudice. The price of the treasuries, if we look at the TLT, which is the ETF for the ultra long, 17 years plus in duration, the thing that no one wants to own, okay? Because we got inflation. Inflation is receding. But they have mean reverted. The price has fallen by 50%. You are 2 to 3 standard deviations below the long-term mean. And I don't play mean reversion with stocks, but when we come to my compass points, the last time I saw such profound mean reversion was the S&P in March 2009. Right. So I invest without prejudice.
I'm not here to judge.
Everyone judges. We do that in the first 20 seconds. Everyone's already switched off. They're like, that guy's a jerk. So my biggest risk allocation would be in those treasuries. So I said 20 in equities. I'd have at least 60% in the treasuries. So then we come into the alternatives. Yeah, maybe I'd have a bit of gold, but actually I've got the gold mining equities. So I would own, I'm going to say it quietly. I don't want anyone to know. I'd have Bitcoin. Not because I want to change the world and all that stuff. I like buying things that go up and selling things that go down, okay? And Bitcoin.
Because you love sound money.
Again, let's not be prejudicial. I don't want to crucify the common man.
Let's go to Bitcoin Miami right now.
We've crucified too many ordinary folk on the crucifix of hard money and philosophy. Let's keep it real, okay? So Bitcoin, okay, is an alternative to real estate, gold, index-linked securities, et al., okay? It's in a kind of $100 trillion basket of other things. And yet Bitcoin is like $1 trillion. It's like 1% of what it could be. And so I look at it and I'm like, again, without prejudice and just being curious, I'm saying to myself, it could actually, over time, amass a greater allocation in the alternatives bucket vis-a-vis other alternatives. And we saw that. It stole the clothing of gold in the last 4 or 5 years as it went up. So I just think Bitcoin is today, let's call it 25,000. I think it could be, I take drugs. It could be 100,000. It's like, it might go 10, it might go 100. I'm at 25. I'm going to take that. It's
a speculative bet.
It's all speculative, honey. It's all in the future, Everything's speculative, right? Speculative is not a dirty word. It's it's what we it's the day job. We speculate.
Well, gold is definitely a less speculative.
It's gold is the and again, I'm not trying to upset people. Gold is is an absurd asset. It serves no purpose. I mean, okay, if I say something like to your point, and with the banking sector, it's the only financial security which isn't anyone else's, where there's no counterparty,
no counterparty risk.
Exactly, but you have that with Bitcoin unless you're in one of those scuzzball kind of exchanges and stuff like that. So
like the one spamming our comment section.
God almighty! I will never.
That is not the real Hugh Hendry. It's not the real Daniela Cambone. We do not. I am the fake Bono.
but I will not be reaching out and trying to follow you on the gram and asking you to trade.
I wish you were the real Bono, though. Then I would be. Not that I don't love your company.
I know. So we've done 3 quadrants, and then the 4th quadrant is cash.
Yes. Well, now you think it's going to get seized.
Hey, look, if you can get 5% on your cash just now, hit me. Yeah. So what did we do? I said 20% in the equity bucket. I said 60% in the treasuries.
Yeah.
Bitcoin, I said I'd have a bit of the old Bitcoin. I'd probably go through the most grotesque portal that exists, which is Grayscale, because Bitcoin has fallen 60%, and I can buy physical Bitcoin within the closed-end fund at like a 30-40% discount to the prevailing cost of Bitcoin. I'm not a proponent, I'm not a sponsor of Grayscale. I hope that one day the SEC will see fit to turn it into an ETF, okay? But that's where I reside my money. And then finally, cash, I would have a lot of, like all of that other stuff you can buy on margin, and then keep all of your cash at 5%. And then finally, if I was doing a currency, and again, I'd have 100%, I'd be 200%, because this is all, it's all smoke and mirrors, it's all leverage. I would be kind of like 100% long the dollar and short the Chinese currency.
Real estate?
Well, in terms of the real world, I am up to here in St. Bart's real estate.
Oh, well, it must be good being Hugh Hendry then.
Real estate is illiquid. You don't want to be, just now you want to keep loose. The thing you got to value most is your independence and your ability to change your mind and say, you know what, I'm going to say.
Wait, let me ask you this. Because there's a lot of folks who want to leave wherever they're living for various reasons. What's life like in St. Bart's? Do you get bored living on it? Because I know it sounds all great. Island life. Does it get boring ever? No. You love island life.
It's the fountain of eternal youth. I'm like 10, 15 years older when I'm there. It's the most
You're
remarkable.
in a bubble.
Oh, it's in a bubble. Like, people come there and they have an amazing time, and then they go back to real life. So I don't live in real life.
So it's the only place you'd want to live? You feel,
yeah,
have you found your place? Like,
I'm getting divorced. I was with someone for 35 years.
I know.
And so living in a bubble is not something that can accommodate. I've got to meet a real lady again.
Yeah, we got to get you out there.
Yeah, I mean, please, call me. But I ain't going to meet them in St. Bart's. In St. Bart's, I kind of got to hide from folk. People are like, hey, come and have a drink, let's meet.
Yeah.
I'm like, hey, this is my real world. I can't do that,
Yeah.
So, but I lived there because I gave up in the social engagement of trying to reach out to politicians and try and change the world. I'm never going to change it. We're busted. And so I'm trying to keep distance from all the folly. I live on an island which is financially independent. The local government runs a surplus. There are no property, well, there are property taxes, but there's no income and there's no corporate taxation. There's no crime, and it's sunny every day.
Well, I mean, you've traveled the globe, so let me end it on this. Your top 3 favorite cities?
London, LA, New York.
LA.
I love LA. I'm moving to Hollywood.
No disrespect. I was just kind of surprised.
Oh, I love Venice. I'm caught between Venice and Hollywood.
Venice, Italy, or Venice, California?
Venice, once we sort out the profound faults in the global trade system, which inflates Wall Street, the true universal commercial city of the future is Los Angeles, because it's all media.
That's right.
There's 8 billion people, and we've got a lot of these things. Yep. And when the battery dies, we still look at it. We're like, come on, entertain me. LA is the center.
I'm happy you're right now in New York City, one of your top 3. Enjoy it. I appreciate you coming by the studio. Wow, I didn't think this interview would go here.
I mean, let's see if it goes out. I mean, maybe it's my last time. People are like, no more acid capitalism, Bring us a guy in a suit,
You rock, Hugh. I appreciate you coming by. Like I said, enjoy your time. Come by anytime. And thank you for watching. We'll have more great content headed your way on the Daniela Cambone Show. And sign up at danielacambone.com. That's it for me. Thanks for watching.
Opinions opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.